CFP and portfolio manager for Evergreen Wealth Solutions, here with your June and second quarter 2023 market updates, all combined into one. June had a strong month, started as a strong month for equities, and continued that throughout the month as the debt ceiling was resolved and helped lower a lot of the uncertainty and support a true risk-on environment. The positive monthly returns also capped off a great quarter for the stocks. S&P 500 gained 6.6 for the month and 8.7 for the quarter, albeit most of that was from just a few individual securities. The results were also supported by better than expected fundamental performance, with earnings coming in well above expectations. As of June 30th, 2023, the S&P 500 only declined their first quarter earnings by 3.1%, while analysts expected a drop of 8.1%. Fundamentals are typically a driver of long-term market performance, so this was very welcomed by investors. From a technical standpoint, all three major U.S. indices finished above their respective 200-day moving averages, and this is a great sign of both market support and investor sentiment support. International markets also had a positive June and quarter, albeit May's weakness hurt the quarterly returns a bit. The MSCI EFA gained 4.55 for the month and 2.95 for the quarter, and the MSCI Emerging Markets Index had a little bit more challenging time, with the index up 3.9 for the month and 1.4 for the quarter. Technical factors for international equities were also supportive. Turning our attention to fixed income, although stocks rallied during the month and the quarter, the same cannot be said for bonds. Rising long-term rates served as a headwind for fixed income investors, and the 10-year Treasury yield rose from 3.61 to 3.81, while the Bloomberg Ag Index lost 36 basis points, or 0.36% for the month, and 0.84 for the quarter. Yields rose due to better than expected economic activity, and these reports are a really great sign for the overall health of the economy, but they could hinder the Fed's attempts to combat inflation. From an economic standpoint, most of the economic releases in both June and Q2 were very, very supportive of a resilient economy. The May jobs report showed 339,000 jobs added, above the expectation of 195,000. And despite tighter fiscal conditions, businesses continued to invest and hire during this quarter. Consumer confidence and spending also improved for both the month and the quarter. And these positive economic updates show that the economy continued to grow, but the downside is that this faster growth could lead to the additional inflationary pressures when the Fed is trying to combat inflation. So while we expect the Fed to hike another 25 basis points, it did hold off in June, which was a positive sign, and we may only see at most one more for the rest of the year. The debt ceiling being behind us has been a great driver behind the market, but it probably will come back as another hot button issue in 2025. In addition, the banking industry concerns that we had along with this debt ceiling standoff just reminded us that the risks that can come to the market may not be seen, and there is a real risk of having short-term sell-offs from time to time. So while the debt ceiling standoff is resolved, the primary risk we see right now for investors is inflation spiking and necessitating further rate hikes from the Fed, which may not be expected by the market and therefore could put pressure on both bonds and stock valuations. International risks also remain highlighted, specifically between the war between Russia and Ukraine and the slowing down of the Chinese economy. Nobody's really certain what's going to happen there. So while most of the market impact of things like the Russian invasion might be behind us, further increase in hostilities could definitely create uncertainty and volatility. And again, there are many here that we just can't predict. So as a whole, the economic and market updates in June were definitely positive, with better than expected economic fundamentals supporting these market gains right through to the end of the quarter. The economy continued solid growth in June, as evidenced by high levels of hiring, progressing consumer confidence, and continued consumer spending growth. While inflation and the Fed risks are ones to monitor, we've already made positive progress in lowering inflation, and further improvements are expected. There's still real work to be done in getting inflation back to the 2% target, but the data shows that we're headed in the right direction for now. So while there are still very real risks that should be monitored, continued economic growth and market appreciation is likely, as solid economic fundamentals should support markets over the long term. Thank you, and have a great day.